Okay, welcome everybody to yet another important video on the topic of bond pricing. This time we're going to think about the relationship between bond price and various bond features like time to maturity, the coupon. Those are going to be the two most important ones, which we'll also be examining via questions. So your curriculum discusses various relationships. The first one it talks about, although this is one we've already covered in a previous video, the initial video in the series on pricing called Bond Pricing and the TVM, is the inverse relationship that we observe between yields or discount rates or rates of return, required rates of return. So the idea that yields move in opposite direction to price, or price moves in opposite direction to yield. So if yields go up, that's going to cause bond prices to fall, and of course the reverse is true as well. Yields going down cause bond prices to go up, and as I mentioned in that previous video, you can talk interchangeably of either bond prices doing something or yields doing something, because when one does something, the other does the opposite, and that's how people talk about bonds. Please remember that the yield, well, that's realistically the required rate of return, and we use that for discounting. So this gets used as the discount rate in the time value of money worksheet or in the time value of money framework to arrive at the price. And of course, the higher discount rate you use, the discount rate that you use, the lower price, the lower present value that you're going to get. This is where it comes from, sort of. Now, the next effect, and this really is an effect, not just a relationship, is what we call the coupon effect. And as you can see, I've got a numerical question, well, a question which doesn't really need to be solved using numbers, or the calculator. Effect is spelled with double F, but I've decided to do it this way. Hopefully, once we do some computations, it will stick better sort of in your heads. This is all about the sensitivity of a bond price or of bond prices to changes in yields. So as yields change, okay, as yields go up, bond prices go down, but the question is how much? Some bonds will go down only a little, others will go down a lot more. That's what we mean by sensitivity, and one of the explaining factors of that sensitivity is the coupon effect. The other is going to be something called the maturity effect, which is in fact far stronger. Right, the following information is available for 3 annual pay coupon bonds. Bonds X, Y, Z with different coupons and different maturities, although, in some cases there are similarities there. The required market rate of return on all 3 bonds is currently 4%, so that's going to be our yield that we're going to use. Relative to bond X, given a 250 basis point increase in the rate of return required by market participants, bond Y will most likely experience lower percentage change, greater or equal percentage change. So we're focusing on bonds X and Y in this question and thinking about what will happen if the yield changes from the current 4% and goes up by 250 basis points. So basically reaches a new level of 6.5%. That's what 2.5 basis points means, 2.5 percentage points. Right, now you can solve this question without the calculator because you can utilize the coupon effect. In fact, these two bonds, have the same time to maturity, but they've got different coupons, and one of them should exhibit a stronger bigger sensitivity than the other, but let's not spoil the question. Let's kind of do it properly. So I've got my calculator fired up here, and what I'm going to do now is just on the side draw 2 columns. One's going to be the current price of the bonds, at 4% yield, and we're also going to have a column for the new price obviously assuming the yield change and going up to 6.5%. And okay, I'll do one more. We'll calculate the percentage price change, so how big that change in fact proves to be. So you know, if you want to, please do this on your own independently, because what you now kind of have to do is just use the time value of money worksheet to calculate the prices for the first two bonds. That's X and Y. I'm going to quickly do this as well. I'm not going to write necessarily everything out. I'll just tell you what the inputs I'm using. So starting with X, the first bond, we've got a 5% coupon, so I'm doing 5 PMT. Obviously, I'm assuming 100 as the par value, so 100 for FV. Okay, I should have cleared the time value of money worksheet first, I guess, but I had it cleared, so I know it shouldn't be an issue now. But remember, that's always a good idea. 4 years to maturity, so 4 for N. And because the initial yield is supposed to be 4, I'm also doing 4%, 4 for I over Y, and asking my calculator to compute PV. Okay, I can see that the current price would be 106.63. As you would expect, the bond is trading at a bit of a premium to its par value. Why? Because it's giving us a coupon that's higher than what the market essentially requires. What would be the new price with a higher yield? Well, you just need to alter one input, do 6.5 for I over Y, compute PV again. As you can see, the price would have dropped to 94.86, and we can easily compute the drop. 94.86, or the scale of the drop, divided by 103.63. Okay, that's a number below 1. You can easily convert this into a percentage measure. Okay, I just deducted 1, and it shows me that the drop is one of roughly 8.5%. Let's do the same thing for the second bond, that's bond Y. So now I'm going to clear the time value of money worksheet and start afresh. 8 for the coupon, PMT 100 for FV. 4 years to maturity, so N is 4. And the initial yield is supposed to be 4 as well, so 4 for I over Y, compute PV. Right, starting price 100. Okay, let's use the color black. 114.52 over here. I'm not going to bother with bond X, that's with bond Z, that's irrelevant for this question. The new price, once again, just override the 6.5%, so the yield, make it 6.5. Compute, oops, sorry, got the wrong one. CPT PV, okay, 105.14. That's going to be the new price. It's once again a drop. Let's see how big this one is. So look, I'm just removing the negative sign from this, or just simply 105.14. I can type it again. Divide by 114.52. Okay, you get a number which is less than 1. Deduct 1, and this will show you the magnitude of the drop. It's a drop of roughly 8.2%. And as you can see, both bond prices dropped, but this one, bond Y, dropped less. Bond Y is most likely to experience, relative to bond X, a lower percentage price change. That's the correct answer. Now, you shouldn't really need to do in the exam any computations on this, because this should become quite obvious to you once you know the rule. Bonds with higher coupons are less sensitive to yield changes. So the price changes by less of an order of magnitude than with bonds that have lower coupons. Let's write this down. Higher coupon bonds exhibit less sensitivity to interest rate, or basically yield changes, whereas lower coupon bonds are the opposite. They exhibit more sensitivity to the same changes, to yield changes. In fact, the most sensitive bonds, when you think about the coupon having an impact, are going to be zero coupon bonds. So zero coupon bonds are the most sensitive because they've got the lowest coupon possible of them all. So you should be able to answer such a question if you get it in the exam without doing any computations. Just spot that bond Y has a higher coupon, and because of that, it's going to be less sensitive or experience a lower price change. Now, the mathematics behind this is that, you know, bond pricing is done using cash flow discounting. It's a discounted cash flow model, right? So that's what your TVM worksheet does on the or TVM menu does on the calculator. And basically, with lower coupon bonds, there is more of the value contained in of the bond contained in the final cash flow where you receive the principal. With higher coupon bonds, you get more money as the bond progresses throughout its lifetime, and because each cash flow needs to be discounted, you know, changing the yield just a little bit, even up or down, will cause a big shift to the present value total if all that value is contained or clustered towards the end of the bond's lifetime, where you've got multiple discounting factors. You know, you're raising to the power of, I don't know, 30 to, if it's a 30-year bond. With higher coupon bonds, more is received early, so the effect of discounting at a higher or lower rate will not be as severe. Okay, that's the coupon effect. Let's move on to the next one, for which we have a separate question, although this question is very much kind of the same as before. We just change one parameter. This one's going to be the maturity effect, and once again, it's all about the sensitivity of a bond's price, but this time depending on the time it has to maturity. So the same bonds, the same starting yield, but this time we're going to be asked about bond Z relative to bond Y. These bonds differ by having different maturities, although they've got the same coupon. So given a 250 basis point now decrease in the rate of return required by market participants, bond Y will most likely experience relative to Z what kind of change? Well, once again, you don't really need to do the computations. I'll do them with you just for the sake of practice and kind of proving the point. Let's start with the current price. The current price obviously at the 4% yield, and then we're going to change the yield, but this time decrease it by 250 basis points. Good. So take my calculator, clear the time value of money, second ever V, and okay, I don't care about the top bond anymore. I now only care about Y and Z. So 4 for N, number of years, 8 for the PMT, that's the coupon, 4 for I over Y, 100 for FV, compute PV. Okay, the starting value for Y is 114.52. Let's see what happens if we change the yield. Now, this is going to be minus 250 basis points, so we will be going, down to 1.5%, won't we? 1.5 I over Y, compute PV again. Right, you can see the price has really shot up to 125.05. So this is the new price at 1.5% yield. And let's just quickly get the percentage price change computed. Okay, we've got this 125. I'm just getting rid of the minus, so pressing the plus minus key. Divide that by 114.52. That was the starting price. Deduct 1. Okay, I can see that it went up by 9.2%. Let's check out the second bond. The second bond has a longer time left to maturity. So the current price, okay, I'm going to clear the time value of money worksheet to start with. Again, 8 for N, 4 for I over Y, that's the starting yield. 8 for the PMT to be the coupon, 100 for FV, compute PV, okay, the starting price seems to be 126.93. Let's get the new price in, 1.5 for I over Y, recompute the PV, right, okay, it's 148.66. Get rid of the minus, divide this by the starting price, minus 1, okay, something's wrong here, 148.66, sorry, divide by 126.93, right, that's better, that's the answer I wanted. That's an increase of 17.1%. So bond Z has shown a much bigger increase than that of bond bond Y, and so the question was framed in terms of bond Y will most likely experience a lower percentage price change. Why is that? Well, shorter maturity bonds, and this is a fundamental thing for bond investing, right, exhibit less sensitivity to yield changes than longer term bonds do. In fact, longer maturity bonds are can be extremely volatile in response to what happens to yields, so interest rates in the market, which is why if you want to speculate and make money on interest rate changes, use long-term bonds to take either long or short positions. That's what hedge fund managers often do. But if you're somebody who doesn't want exposure to a lot of interest rate risk, hold shorter term securities, which do not fluctuate so much. And in fact, you know, the relatively recent, this happened not so long ago, last year, in relation to when I'm filming this, the fallout at Silicon Valley Bank had a lot to do with that bank investing in long-term securities. They were safe securities, government securities, but at a time when interest rates were quite low. And then when interest rates went up, the value of those long-term bonds with a fixed coupon fell because yields and bond prices move in opposite directions. But because Silicon Valley Bank held long-term fixed coupon bonds, which are very sensitive to interest rate changes, the fall was quite extreme. More sensitivity to yield changes. Simply, let me just say that there is a small exception to this rule. I'm pretty confident this wouldn't be tested, but it is mentioned in your curriculum, so I am sort of writing this down. Long-term bonds with low coupons, but not zero, which trade at a discount. These ones will not necessarily be more sensitive than a shorter term comparative instrument, but that's an exception, you know, it's very sort of obscure. Don't worry about it too much. Now, your book in this relevant section, or this lesson, also talks about two other relationships, which I've already covered in other videos. One is the constant yield to price trajectory, and this is all about what happens when you've got a bond trading at a discount or a premium. That premium or discount disappears over time, providing other conditions don't change, and this is called the pull to par. And I've discussed this in a previous video, so see the bond pricing and the TVM video. It's discussed over there with you know, a graphical representation as well. And the other effect is the convexity effect, for which I've already done a video as well in the distant past, and it's the next video on the playlist. So I separately talk about that one there. I do a question on it. See next video. The idea is when interest rates change, or when yields change, let's say by 1 percentage point up or down, obviously the bond price will adjust, but it's not going to be a uniform adjustment. And that's what the convexity effect is all about. So see you in the next video for that. Okay, thanks for watching.